The monetary policy rate generally signals the rate at which the Bank of Ghana lends to commercial banks, which influences the final interest rate corporate entities and individuals pay on the loans they take from these commercial banks. The rhetoric, however, over the years from many micro, small and medium-scale enterprises when it comes to loans is the fact that even when the central bank reduces its MPR rate, the transmission mechanism, which should see a commensurate decline in lending rates of commercial banks, does not apply. So why is this the case? Nanotui Champong is a banking consultant and he gives some reasons for this phenomena.
To start with, the rate has been dropping from the 30s and 40s. Now it's in the 20s and even in the 10s. Now there are two main types of loans at lending rates. That is corporate and personal. Usually the corporate ones are secured, and the more security you have, the lower the interest rate becomes. Now the MPC rate now is 14.5, and at the corporate level, some banks are borrowing. The actual blue chip companies are borrowing near the MPC rate of 14 to 15%. But when it comes to the personal level, where they're usually unsecured, then because of the risk factor, risk being that the chances of the borrower not being able to pay, then it means the bank has to add a risk premium, and that is presently around 2022, 23.
To see to the reduction of lending rates from the highs of over 30% in years past, the central bank in 2018 introduced a new reference rate for lending, the Ghana reference rate, to serve as a guide in the setting of interest rates on loans by all banks. Referred to as the new base rate, the GRR began the year 2020 at 16.13% and has dropped to 14.77% as of September. It is interesting to note that in the months after COVID-19 was recorded in Ghana, the GRR started dropping, albeit marginally, which translated in a corresponding marginal drop in average lending rates. Here is Nanotui Champon further highlighting the dynamic of the current pandemic and how it is keeping interest rates from dropping further.
Over and above all this, and not in old times, we are in new normal. And the new normal, the chances of loans either going bad or becoming doubtful are real. In the sense that people who borrowed before the COVID pandemic, now they use the money and their businesses have either come down or in some ways cases collapsed completely. So that risk is also adding to the mountain of non-performing loans. And the higher non-performing loans you have, the dearer cost of borrowing becomes, because you have to share that risk.
Hi guys, I hope you enjoyed this video. Subscribe to our Citi TV YouTube channel for more videos on the Business Dashboard.
Tune in and stay updated on the key business news stories of the day with Business Dashboard every weekday at 7 p.m. only on Citi TV.